Risk assets in 2026. If stocks and crypto keep rallying, what happens to Forex? When stocks and crypto take off, most people assume Forex fades into the background or just becomes a spectator. In 2026, it doesn't. This is actually where global risk appetite shows its real impact, just not in a loud or emotional way. The rally in risk assets. When stocks and crypto are pushing higher, it usually means investors are feeling optimistic. Fear starts to fade, risk appetite comes back, and money begins chasing higher returns. Lower interest rates play a big role here because cheaper money makes taking risk easier. At the same time, new technologies, especially AI in recent years, have been driving growth in tech stocks. And when economic data supports a positive outlook, that momentum builds even faster. Crypto moves in much the same way. When confidence is strong, capital flows into digital assets and prices can accelerate quickly to the upside. What risk on means for Forex? As stocks and crypto move higher, investors naturally shift away from safety and toward growth and yield. In this phase, capital starts moving with intent. Money flows out of defensive assets and into higher risk ones, and that shift can reshape the Forex market very quickly. Currencies don't move randomly here. They react to where capital is going and what's driving it in the first place. Which currencies win and which ones lose. At this stage, the first currencies to feel pressure are the traditional safe havens. The US dollar is a key defensive asset. But when investors stop looking for protection, demands for the dollar fade and large institutions begin cutting exposure. The Japanese yen follows a similar pattern. It's another classic safe haven, and when optimism takes over, the yen tends to weaken, which is why pairs like USD JPY often move higher. The Swiss franc usually comes under pressure for the same reason. At the same time, risk-sensitive and commodity-linked currencies start to benefit. The Australian dollar is a good example, since Australia's economy is closely tied to global growth and commodities. When the global outlook improves, AUD tends to strengthen and often becomes one of the stronger performers. The New Zealand dollar behaves much the same way, while the euro and the pound also tend to gain against the dollar when risk appetite is strong. Trading strategies in a risk-on phase. So what does this phase actually look like for Forex traders? It tends to show up through a few clear strategy patterns. The first strategy shows up as pressure on safe haven currencies. When risk assets are leading, selling safe havens often becomes the natural move. That's why the dollar tends to come under pressure during these phases. Pairs like the Euro USD, Great British Pound USD, and Australian Dollar USD often start pushing higher as capital rotates out of defensive positions. The second strategy is strength in commodity currencies. Commodity-linked currencies usually begin to stand out here. Australian Dollar USD and the New Zealand Dollar USD often benefit because of their close connection to global growth and equity markets. When optimism builds, these currencies are often among the strongest performers. The third strategy brings carry trades back into focus. When risk appetite is strong, carry trades start to make sense again. Borrowing low-yielding currencies like the yen and moving into higher-yielding ones becomes more attractive as investors search for return. The fourth strategy is about sentiment confirmation from other markets. What matters most is alignment. Watching equities and crypto helps confirm whether these conditions are actually in place. When indices like the Nasdaq and the SP 500 are moving higher, it often reinforces the backdrop and helps keep Forex traders in sync with broader market momentum. How to take advantage of the trend? The key is sentiment. Watching stocks and crypto gives you a very clear read on whether the market is leaning toward risk or pulling back from it. When these markets are moving higher together, this phase is usually in play. When they start to roll over sharply, sentiment often shifts the other way. Understanding correlations also makes a big difference. The Australian dollar often moves alongside Chinese equities, while Bitcoin tends to track tech stocks. Keeping these relationships in mind helps you see the bigger picture and therefore make clearer decisions. As stocks and crypto push higher, Forex traders usually start to see opportunity. The dollar comes under pressure, commodity currencies like the AUD and NZD gain strength, and setups such as long Euro USD can start to work well. If this rally keeps going, where do you focus your attention? Continued weakness in safe haven currencies, or competition among risk-sensitive currencies for incoming capital? And which of those do you think creates the better opportunity for Forex in 2026? Let us know in the comments.